Okay, good evening. Unit holders of Cromwell European REIT, participants and media. Thank you very much for joining us this evening at this Cromwell European REIT or CEREIT inaugural virtual investor day. Now, CEREIT is Singapore's largest REIT to have a 100% European commercial real estate portfolio exposure. They focus on a majority investment weighting to the light industrial logistics sector, while also investing in core office assets in gateway cities. CEREIT is a 2.6 billion euro portfolio, comprises 110 plus predominantly freehold properties in or close to major gateway cities across 10 countries. In Europe, with about 86% exposure to Western Europe and the Nordics, an aggregate lettable area of approximately 1.9 million square meters and 800 plus tenant customers. Tonight, we shall discuss some of your concerns that you have expressed to us, and we are aware, in particular relating to DPU and share price, which are very common topics with regard to REITs. We will kick off tonight's session with an update on the latest insights on the European commercial real estate market by Mr. Jo Krendel, Head of Industrial and Logistics Occupier EMEA at CBRE, followed by a presentation by Mr. Simon Garing, Chief Executive Officer of CEREIT, there he is, who will be sharing on the REIT's third quarter 2022 business performance and strategy and outlook. Okay, so without further ado, they're all waiting to hear you, Jo. So would you take over, please? Tell us where you are. Sure. First, tell us where you are. You're from. You're right now.
Let me just share my screen. Can you hear me? Can you see my screen?
Yes, we can hear you.
Perfect. Thank you very much. And thank you very much for having me. My name is Jo Krendel. As David introduced me already, I'm based in Austria, Vienna. It's about lunchtime here. Very, very happy to be with you. I run our industrial logistics, occupier and leasing business across continental Europe and the UK, and I've been given the opportunity to present to you today. I run our business here, meaning I'm really the connection point between the various domestic teams that we have across the continent. We're doing industrial agency, we represent occupiers, we represent landlords, we have a very good insight into what's going on in the markets. I am not a researcher, I'm a hands-on transactional and broker, really. So I'm out there in the fields working with the teams on deals. And I'd like to basically give you a bit of a combination of what we see data and research-wise, but also you can ask me questions on specific transactions or specific trends that you're interested in. So let me just kick off very quickly in terms of what we're seeing. I will speak first about the drivers that we see in our sectors, and secondly, I will then follow through with a few leasing specific data that we see on the continent. What you're looking at here is the configuration of take-up that we see in Europe, and you see the percentage basically there. So we have the online piece, we have the hybrid piece consisting of online and offline, we have the classic offline piece consisting more of production. The online element, and maybe that's been part of your concern, obviously has gone through an interesting evolution over the last few years. What a lot of people forget is that this development has been going on for quite a few years, and I will show you a graph to that in a second. We've had an enormous peak, obviously, during the COVID times. It's coming down now a little bit. Amazon is part of this. Amazon has really almost stopped acquiring more space. So far, that dent in the market has, however, not been a very relevant one, because it has really been compensated by a lot of other occupiers. So online has kept us busy for many, many years. It has kept us enormously busy for the last 2.5 years. It again has come down a little bit, but not massively. Omni-channel retailers, third-party logistics operators, post and parcel process operators are still the main part of the take-up really out there, and that is not going to change anytime soon. And we still have a very healthy element of offline business, production, manufacturing in general. Let me come back to online for a second, because I think this is very important for you to understand. You see here the online penetration rate in terms of e-commerce. In here we took the UK as obviously one of the strongest market in Europe in this context. We're looking at the European average, and I picked one country, Spain, but you see basically it's the very same pattern. It has been growing. In that case, we show the growth since 2015. Then we have a massive peak during the COVID period, the COVID lockdowns. But what you see very interesting is that the forecast is that basically we're now continuing on a much higher level than we would have been without COVID. COVID or no COVID, basically online is here to stay, it's here to grow, and it's here to, you know, keep on having a strong implication on the warehouse business, i.e. it will keep remaining a main driver for take up in the logistics and industrial business. Number two, supply chain interruptions of all kinds. And what you're looking at here is an excerpt of an occupier survey that we've run, admittedly, in the first quarter of this year. But basically, virtually every occupier is saying to us that they were, of course, affected by global supply chain problems, disruptions of all sorts. 32% at the time said that they do not see this ending before 2023. Some of them saw it ending earlier, some of them saw it ending later. It will be very interesting to see what our occupier clients are going to say when we repeat this survey later this year, beginning of next year. I think this will just show that this disruption element is not going away anytime quickly. And again, it will keep nurturing our business. Number three, I would like to mention that in that case, it's kind of a proxy for other regions, but Central Eastern Europe, but not only Central Eastern Europe, has experienced a massive interest and attraction of production-related inquiries and projects over the last few years. A main factor there obviously is labor costs, which are still very, very attractive comparing to Western Europe and probably comparing to a lot of other regions in the world. So despite the relatively or very low unemployment rate in Eastern Europe, we still see a lot of production related projects coming to Europe. Quickly, leasing market. What you look at here is, sorry, the blue bars basically show you the evolution of take up. In that case, we look back roughly 10 years from 2013 until including the third quarter of this year. So you see clearly the massive evolution, the massive growth that the growth pattern that we've seen over the years. You see on the other hand the average vacancy, well, the vacancy rate, and you see how contrasting these two developments have been happening basically. So in some cases in Europe we have an almost, I would say, from an occupier perspective, almost dramatic situation looking at the vacancy rate and the demand that we're seeing on the market. So you see, again, if you focus for a moment on the years 2020, 21, 22, a massive increase in terms of take up quarter by quarter, up to 35 million square meters. And the vacancy rate is still coming down, and that creates a massive challenge for the occupiers, but it also obviously represents a massive opportunity on the investment and development side. Quick look back again to our occupier opinion on how this is going to play out for them in the future, despite the fact that there's hardly any space available. 73% of our occupier clients are still saying that they are looking to expand over the next 3 years and will grow by either more or just below 10%. So that still is, again, a testimonial to our business. How have the various markets reacted to the vacancy rate in terms of providing more stock to the market? It's a very, very different picture that you see across the market. So you see, for instance, in Poland, they've been adding much more stock than, for instance, France and Germany, which again has an additional implication on availability rates, of course. Very important, and I think that's very, very relevant for Europe, is that a lot of occupiers are now looking at expansion outside of the traditional logistics hubs. That has a number of reasons. Obviously, cost is one thing, and we'll look at the rental level development in a moment. But one thing is for sure, and it's very relevant for Europe. We have a very strong problem around availability of land. There won't be more land, as we all know, and planning and permitting on new land is very, very difficult. So that basically forces a lot of occupiers to think in alternative ways, move from prime to less prime locations. But obviously, on the other hand, it basically says very clearly that investment in traditional hubs and also in alternative hubs is a good one, because there will be more demand and there's simply hardly enough space for all the demand that we're seeing. This is a very important one. Annualized average prime rental growth. You compare, basically, we're comparing here 2 different periods of time. The one is from 2012 to 2019. That is the green part. And then you see the blue part, which is basically looking at the same, of the rental growth between 2020 and the last quarter of this year, that's the third quarter of this year. So you see what has been going on basically only in these last 2 years, hardly any rental growth in 7 to 8 years, and a massive rental growth just in the very last 24 months. So you see London's leading the pack, but we basically see the same pattern across all of Europe. And in many cases, that rental growth has really only started in the last 9 or even less than 9 months. So the development that we're seeing here is absolutely challenging for the occupiers, and a very positive thing, of course, for the investors. And that is not going to stop. We forecast now the rental growth again against the years 2015 to 21 versus 22 to 27. So this is a development that we still see continuing. To be honest, I think this in some parts this will be even more dramatic than what we're looking at this graph. So just to summarize, and this is again an outcome of our occupier survey. The occupiers say that real estate availability, labor availability, quality of business infrastructure are the leading factors in making location decisions. Real estate availability over a long time has not necessarily been on top, but it is now, because it's just a very, very scarce commodity. Occupiers are going to be more willing to compromise on other factors such as labor cost, proximity to the motorways. That was the number one for many years. Distance to relevant commercial locations. So we see there's quite much more flexibility given now on the occupier side. So I've come already to an end here, David. I'm very happy to take questions afterwards about everything that I said. Over to you, Simon.
Thank you, Jörg. And again, good evening to everyone. It's a delight to be here with SIAS, David hosting us, and also again to Jörg for your valuable contribution as one of Europe's leading logistics advisors and agents. So that's terrific that the investors get a chance to hear from someone other than someone like me. We have a very short video to play. So Elena, over to you to click the go button, please. So I'm not sure if the music's happening, but what we're effectively showing here is the quality portfolio of both commercial and logistic assets. And really the purposes of tonight is to provide to investors insight into our strategy, as well as providing an update on current conditions. We released a presentation to the SGX tonight, which again has some new information in it that we haven't released previously. So again, it's great to be able to take you through it this evening. So a good combination here of warehouses situated in 8 countries, substantially leased to major 3PLs, as well as major light industrial operators from the logistics perspective. And I'll take you through also on the office side of the portfolio as well. And we'll talk a little bit about the development upside. These are some of the schematics of projects that's currently underway. Good. Thank you. So we'll just turn to the slide pack now. Thanks, Lena. So from the slides, we can see, and David's obviously introduced 2.6 billion euros worth of commercial assets, a very substantial portfolio, almost 2 million square meters. To put that into context, that's around 1/3 of the size of the total commercial market here in Singapore. So just in this one portfolio, we have almost 1/3 of the size of Singapore in total. If we turn over to the next page, we'll just go through our strategy for long-term value creation. So really a couple of things to note. One is very active asset management of a high quality portfolio. We started 5 years ago, almost to the day. Tomorrow, in fact, is our 5-year anniversary. We started life at 88% occupied. We've managed to continue to grow the occupancy, and we've just reported another record level. We're also able to drive higher rent reversion on leases that are expiring, both in logistics, as Jorg mentioned, but also in office. Every lease has some form of index inflation escalators and rent reversions, which will continue to support the NPI growth. And as well, obviously, in the near term, managing the higher energy costs for the tenant customers and taking advantage of the many government subsidies to help support the tenants, who in 95% of the cases within the CEREIT portfolio pay their energy prices directly themselves. From a second perspective, certainly maintaining our pivot to logistics that we started a couple of years ago, and again, to take advantage of the very strong long-term fundamentals that we've just heard from. Secondly, we do have an office portfolio that is a combination of platinum grade premium assets, as well as assets that are now ready to be enhanced, or AEI, to that premium. And that's certainly where the office occupiers are switching at the moment. Having an ESG or BREEAM certification on the office buildings is certainly something that's relatively unique in Europe, with only about 20% of the office assets BREEAM certified. So that's certainly something that we will continue to promote. And then from a growth perspective within this pivot, we're looking at around 250 million euros of asset enhancement and development opportunities. From an organic perspective, these are assets already sitting inside CEREIT's portfolio. We're predominantly freehold titles, so of course, adding any value to the fundamentals of each of these buildings is completely captured by the CEREIT investors, and there's not the leakage as you see in leasehold markets. So that's a really important point. So pivoting to logistics, getting the benefit from the higher rent growth coming through from the fundamentals, as well as the higher inflation numbers, driving the earnings growth. Importantly, as we move into this higher interest rate cycle, we will continue to maintain ample liquidity. And 2 weeks ago, we were really thrilled to be able to announce a major refinancing package which really deals with the near-term expiry over the next 2 years of our debt facilities. So that's certainly something that we can now take the risk out of, and I'm sure David will ask some questions on this in a minute. And it's really important to focus on ESG standards, not just the environment, not just the E, that's obviously very important for the tenants, but from you as an investor perspective, the governance in particular is something that we at Cromwell strive really highly for. So how do we execute this? Well, obviously we leverage Cromwell's local teams on the ground, and I'll show you a slide in a minute of their strength. Certainly funding the developments through cash and asset sales in the near term. Clearly our depressed share price makes it difficult for us to raise capital. It wouldn't be accretive for us to do so. So selling assets and using that capital to fund our development projects is really important. And managing obviously the risk and the volatility through the early refinancing is something that's really important. And many brokers in the last few months have been downgrading earnings from not just Singapore REITs, but globally with the marking to market of the higher interest costs. So that's something that we've largely now taken care of. So Cromwell has been operating in Europe for over 20 years. They've got 220 staff in 17 offices across 11 countries. So it's really important that we have these local talented executives on the ground doing the asset management, making the acquisitions, looking after the disposals, and certainly arranging the development, the planning permission, the planning processes, as you mentioned, can be quite lengthy in some jurisdictions in Europe. That's a double-edged sword. It's good in that it protects us from new supply, but if we want to do the developments, it does take us a little bit longer. So after 5 years, we've now started our development program, and so we're certainly looking forward to announcing some early wins on our developments. So from a risk perspective, let's now look at who's paying the rent, who's paying the distribution. So we have close to 1,000 leases, almost 900 tenants. Even during the 2020 recession of the pandemic, we only lost about €500,000 in rent abatements across a total 150 million euros. So in other words, our tenants are very secure in that they've paid their rent during 2020, and we see no reason why, again, we can't collect close to 100% cash over the coming more shallow recession that's expected. From a credit perspective, we don't have a concentration in any one particular tenant. Our top 10 tenants make up 30% of the income. No one industry makes up more than 14%, so we're not highly levered to the banking and financial sector, not highly levered to, say, the tech sector, so a good spread of industries. And only about 8% of the tenants in total are SMEs. In other words, we've got a very high proportion of government, semi-government, blue chip and large MNCs throughout the portfolio. So again, that's a really strong backdrop for that resilience that worked its way through the portfolio in 2020, and we expect to also help with 2023 as well. In terms of the next page around the occupancy levels, again, to highlight, we're at a record high at 95.7, even in the last quarter with rising interest rates and with all the other issues that are well documented, we were still able to lease almost 4% of the portfolio at a really strong rent reversion, almost 7% higher rents on renewals than previously paid. So higher occupancy, but also with higher rent growth. More specifically on the light industrial and logistics, which is really the focus of tonight's presentation, we've been able to deliver almost an 8% rent reversion, and again, a very high level of occupancy. I would call 97.5% almost full house. Very difficult to get to 100% because there's always that delay when a tenant leaves because they need more space. We can't provide it. It takes a couple of months to secure. Really, this portfolio is anchored by a fantastic asset in Paris called Parc de Dock. It's 10 hectares of land, 3 kilometers from the Champs-Élysées, right in the middle of the new Paris Olympic Village and all the stadiums and infrastructure like the new Paris North Hospital that are being built in the surrounding environment. So very much last mile logistics to major tenants like UPS. And it's something that longer term, you'll see a lot more value being created from this specific site. But that really is the jewel in the crown across what is a very successful portfolio of light industrial and logistics. And if we look back over the last 5 years since listing, we started off with about 1.4 billion euros of assets. And then in the last couple of years, we've bought almost 400 million euros of logistics, taking the number of assets up to over 110 assets and now a value of 2.6 billion. So almost doubling the size of the portfolio, but importantly, pivoting more to the logistics. So now having almost 50% weighting, up from almost only a third of the weighting of the portfolio. So really, again, trying to take advantage of these structural benefits that Jorg was talking about earlier. You'll also note that we've been selling assets. We've sold a number of assets to date. We'll continue to sell. This is important because, again, when our cost of equity is so high, when our discount to NAV is so low, it's not accretive for us to raise capital through the equity market. But if we can raise the capital through selling and recycling non-core assets, then we can improve the overall quality of the portfolio without having to raise that dilutive equity that everyone's trying to avoid doing. The next page will highlight the growth in the NPI, the net property income. Again, the logistics in the blue bar here again highlights that we're around 24% higher on a rent basis, and a like-for-like basis, we've just reported a 6% higher logistics NPI. Turning on to the next page, just very quickly on the office side of things, what we're seeing across the prime office markets is still rent growth. So notwithstanding work from home, we are seeing a reduction in vacancies in the last 18 months since coming out of COVID. But the bigger trend is the occupiers looking to move from those out-of-town business parks, the B and C grade buildings where there's not a lot of employee amenity, there's no restaurants, there's no food, there's no social gathering places, and no public transport. And we're seeing a lot more movement of tenants into not just ESG rated property, but also ones that are very well conveniently located close to public transport, etc. And so that's playing into a large part of our portfolio and really is a second leg of our strategy. So the first leg obviously is logistics, and then the second leg is to convert some of our older assets that are very well located in markets such as Milan, Rome, Amsterdam, into premium buildings. And with that, we get the development profits, the higher rents that we're able to achieve in these markets. And so that's something that you'll hear a lot more of over the coming years. So this is an organic pipeline sitting within the REIT, not sitting within the sponsor, but sitting within the REIT. So the REIT investors benefit and participate in the higher development profits that we expect to be able to deliver. From an ESG perspective, we believe that we're a leader here in Singapore, in part because of the very stringent criteria that we have already in Europe that we have to comply with. So from an environmental perspective, there's a lot of onus on regulations around energy consumption, efficiencies, greenhouse gas emissions with some 2030 targets, particularly when we look at the Paris Accord. So that's something that we're already well underway in our journey to deliver the zero carbon emissions by 2040 that we set out earlier on this year as our aspirational target. A lot of tech is being implemented across 10 countries. It will take us another 12 to 18 months, but this is something not just equity investors are looking for, but something that debt investors and banks are also now looking at. So when we talk shortly about our recent loan, a lot of benefits we've received already from the banks comes through on our ESG initiatives. So I'll just pause on the strategy side of things and now move to our business update, and just very quickly, because I know David's edging to get to some questions. Again, just to highlight, very strong property income in the context of all of the negative press that you read around Europe. Here in Singapore, still able to deliver a 3.8% year-to-date increase in income available for distribution. We only pay dividends every 6 months. So for the Q3, we haven't announced the distribution. That'll be announced for the second half of the year when our results come out in February. Really important around the credit metrics, new facility, effectively refinancing all of our near-term debt. 76% of the debt is either hedged or fixed over the next couple of years. 38.9% aggregate gearing. Again, that puts us in a very comfortable range. And then from a performance metric perspective, again, that increase in occupancy, rent reversion, and almost a 5-year weighted average lease to expiry. We'll just skip over to page 16 and just talk about that recent refinancing, because I think this is really important in the context of why REITs have been sold and what we've been doing to address the concerns of the investors. And the first one is really around the refinancing. As central banks globally are reducing money supply, the access to credit becomes not just more expensive, but conditions of lending increase. So to be able to lock in our debt now out to 2026 is really a relief for us and our equity investors, in that it now takes that risk off the table. The second risk at the moment is around the rising interest rates, and therefore the impact on interest expense and what that might do to the dividend on the downside. The fact is that every company, every REIT is having to go from, that fuel of very cheap money to now more normal rationed cost of debt. So all of us, all of your companies that you invest in, not just REITs, are going to go through a transition phase to a higher interest rate. And that's something that we've been expecting for some time, and I'll talk about it in the Q&A as to how we've mitigated some of that risk. But certainly from a Singapore REIT perspective, we're roughly 76% hedged, which is in line largely with the peer group, or at the top end of the peer group from a hedging perspective. But we'll show you a chart in a minute that shows that Euro debt is still very much cheaper than that in the US or in Singapore. Really, I wanted to draw out of this page a couple of things. One is that Fitch, our credit rating agency, just recently reaffirmed our investment grade BBB- rating. So that's really important. That's not just me talking about the resilience of the portfolio, it's the credit rating agency. The second is that from a loan covenant perspective, and I noticed that CLSA put out an article yesterday, which was reported widely in the press today, that this is something that they're also looking at from a broker analyst perspective, as well as other brokers over the last couple of months. But, low leverage at 38.9% gives us some headway should real estate values fall. LTVs will go higher, but we have plenty of buffer to our covenants. The second most important criteria, which is really the one that the banks focus on, is the interest cover. In other words, your ability from the earnings that you receive from the properties to repay your loans, to repay your interest. And so our interest cover is at 6.5 times, and that compares well above not just the Singapore peers, but obviously well above the MAS regulations of 2.5 times and our bond covenants at 2 times. So to put it into perspective, ECB would need to lift interest rates to 11% as a sensitivity analysis for our ICR cover to get down to that covenant from a level of only 1.75%. So I think if the ECB went to 11%, there's a lot more other issues than just our ICR, but certainly there's a lot of buffer in our loan covers. So look, in summary, some takeaways. CEREIT has a high quality portfolio. I know sometimes it's difficult here in Singapore to really recognize the quality of our Dutch office assets, for example, or our French or German logistic assets, or our recently acquired Danish or UK assets. But in terms of the track record, I think we show that not just the assets themselves, but the active asset management teams on the ground have been able to drive higher occupancy, drive higher rent reversion, which will offset the higher interest costs, which are starting to flow through. So our income available for distribution was up around 4% year to date. Again, as Jorg has mentioned, very strong fundamentals in European logistics, and that's something that we will continue to take advantage of, and we'll continue to look for acquisitions, particularly when our cost of capital improves. And finally, really this focus on ample liquidity and reducing our financing risks is something over the next 12 months, when other REITs find themselves in more difficulties, that at least on a relative basis, we'll be able to say to you as our investors, we've undertaken most of that refinancing already. So from an outlook perspective, expect to maintain a very high occupancy level, expect that the inflation-linked rent increases and the positive rent reversions will support our property income. The current construction projects and the planning for the next phases of our other office upgrades and logistic developments will add to both dividend and NAV growth over the medium to long term. In the near term, we're going to focus on selling assets, recycle those assets to fund those AEIs. Key risks clearly around the energy pricing and supply interruptions, but Europe has done a very good job preparing for the winter period. Prolonged inflation, what that might mean for geopolitical tensions, the global supply disruptions, and unfortunately any unintentional escalation of the Ukraine war are all sort of risks around us, and that is likely to lead to potential valuation decline. So robust income, some risk on the interest costs, some downside pressure on the valuations, but plenty of buffer from a LTV and covenant perspective. So with that, David, I might hand over to you.
Thank you, Simon, for that encouraging presentation. But let me ask you, is Putin likely to douse your expectations?
So there's a couple of ways of answering that question. The first is obviously the global macro implications and what that does to global growth, particularly around agriculture and food shortages, with Ukraine being a major provider. So that's certainly something from a humanitarian perspective that we would be very concerned with as first and foremost concern. The second is around the refugee situation. And so we've already dealt with 2 to 3 million refugees in, say, Poland. We have an 8% of our portfolio is weighted to Poland. So we've got a small amount of vacancy in some of our assets, and we've been able to use some of those vacancies to help with the humanitarian aid through, say, sorting centres, or using some of our shelters for hospice for particularly in children and their mothers. So again, everything we're doing, our teams on the ground, 45 people in Poland from Cromwell, are really helping and working with the local authorities. I think if your question is more around the earnings outlook then for CEREIT, so one of the advantages we have, of course, is we've got long leases.
Right.
And so in Poland, with 8% of our portfolio there, our key tenants are groups like Santander Bank, UBS Bank, BNP, Motorola, all on very long leases. So
and five-star tenants.
Yeah, and they're paying their rent. We have 20 tenants in Poland, and most of them are large global blue chip tenants paying their rent. Right. From a pan-European perspective, it's actually, from a European project perspective, it's actually bringing 450 million people closer together. Right. So maybe I could ask Jörg to answer from his perspective, but from us, it's energy prices. Governments are stepping in and helping out with support mechanisms. From a food and inflation perspective, obviously the ECB is trying to lift rates to help mitigate some of the inflation. And 3, from an economic perspective, we're seeing a lot of fiscal support, and ultimately ECB won't lift interest rates nearly as much as what's already happened in the US and Singapore if the recession in Europe takes a greater bite. So the bright light, of course, is lower interest rates is actually very good for us. So never want to make a gain out of a humanitarian crisis. So I'm not focusing on that part, but we should recognize that longer term, it's actually okay for us.
Okay, so you touched on some key financial metrics, Simon, such as higher revenue, higher net property income for third quarter 2022. Unit holders are keen on distribution. That, as you know, we got number of people depending on DPU. So does Cromwell REIT only give out distribution to unit holders half yearly, as you said, or can we expect you to consider making a quarterly distribution? A question that a number of retirees asked me to ask you.
Yep, no, I appreciate that. And I appreciate that a number of REITs, albeit a minority, do pay quarterly distributions. Yes. So when I first joined as the CEO of the REIT, it was one of the first things that I asked the team to look at, coming from Cromwell Group, that in Australia does pay a quarterly distribution. So it's in our DNA to pay one. Right. There are a couple of factors, however, why we haven't been able to put it on. The first is we pay a dividend in both euros or in Sing dollars. So 75% of our investors elect to receive their distribution in euros. That adds complexity to CDP. So it's very complicated for CDP and very expensive. They charge us a lot if we were to move from 6 monthly to quarterly, because every quarter they would have to ask the investors whether or not they wanted to receive euro or Sing dollars. We also have a DRP on. They need to ask. So it ends up costing a lot of money. So if you and your contacts can work with CDP to get them to lower the price, then it's certainly something that we should be looking at. The second is from an efficiency of cash management perspective.
Yes.
It's more accretive for us to pay down our debt for that 6-month period, particularly in rising interest rates, than paying the cash out to investors. So conversely, our dividend would fall in a higher interest market if we couldn't repay the debt during that period.
Okay, so you've got
when sorry to interrupt, but when we had negative interest rates,
yes,
we had a lot more incentive to get the cash out because it was costing us money
yes,
to hold the cash. But today, at the higher interest rates, it's actually benefit for investors from an overall long-term dividend. We did have a DRP on at the current share price. We've taken the DRP off because it's just too dilutive.
The question arose because your distributable income is about 25 million euros per quarter. That's why. Okay, let's look at the third quarter performance. If we were to look at the 9 months performance, Simon, revenue is 9.1% year to date and 2.4% compared to third quarter 2021. However, income available for distribution is only up 3.8% over the 3 quarters, and in fact down 0.4% compared to third quarter 2021. So the main question is, what are the main reasons for the decline in distributable income? How much of it was due to higher borrowing costs?
Yeah, so almost all of the answer is in the higher interest costs. So as I said in my prepared remarks, investors will need to factor in that any company that they invest in that has debt is going to see the cost of debt increase. It's a question of how quickly that cost of debt materializes, and that's a function of hedging. So what we did see in the third quarter is the higher interest costs starting to come through. And we can talk about a sensitivity. I think Elena has a sensitivity page that is prepared that we can turn to if you need more details on that. But roughly what we're saying today, and David, this is a first slide that we've released to the SGX with this level of detail, so you and your investors are seeing it first, is if we assume next year that the 3-month interest rate averages 2.5% for the full year, 2.5% for the full year, then you may see our distribution reduce from 17 cents to 16 cents, i.e. drop by 1 cent. That's not a guidance, that's not a forecast, because clearly interest rates are lower than that. They're currently about 1.4, 1.5%. But we did want to help your investors understand the sort of the bookend of the issue, which is around 1%, 1 cent off that distribution if the market forecasts are correct. Now, clearly, if the ECB doesn't lift interest rates, then that scenario doesn't come through.
So is it almost certain that the high borrowing cost will erode the REIT's DPU going forward, Simon?
Absolutely. Yeah.
That seems to be...
That everyone has that problem. Right. So if everyone listening today thinks that their distributions, unfortunately, won't be impacted by the rising interests, unfortunately, you know, we have protected it, we have mitigated it. Again, CLSA today has downgraded some REITs by 16 to 18% on their dividend. What we're showing you here is a scenario that shows, you know, less than a 10% decline. So when we're trading at $1.50 per unit, and our distribution is 17 cents, that's a 12% yield, David. We're currently offering investors a 12% yield. Now, even if the dividend falls on the back of this scenario, that's still a 10% yield at today's prices.
Very
So,
good.
so
Yeah.
we're being, I would argue that we're being priced for a larger cut in dividend, which was why we thought it was really important tonight, knowing that this question would come up, that we would at least provide this scenario, which is more detailed than any other REIT has provided, to at least show you and your investor base that the fall is not as much as many of the other REITs.
Right. Simon, operational wise, what are the most challenging cities or countries for you?
Definitely Poland. Office assets in Poland. Poland is a very high GDP growth economy. And then unfortunately with COVID, we had a number of office buildings still going up under construction, but we didn't have the same number of tenants that would normally come in into Warsaw. Warsaw is really a BPO market. It's very much like a Chennai or a Manila. A lot of those big banks that I mentioned as tenants of ours, it's the back office, it's the business processing office with much lower salary. So we're suffering at the moment in our portfolio from the exposure to Poland, which has a higher level of vacancy than across the board. So look for us to sell some of those Polish office assets over the short to medium term.
And is there any silver lining in Europe, given that all we hear are mostly negative news from Europe? But do you think there's a silver lining in some way?
Well, I think this is why it was really important for Jörg to come on and give, on the ground view on logistics. And, the silver lining there is very low vacancy, very strong demand from e-commerce take up, supply chain shifts. I saw a stat there that the forklift driver in Central Europe is being paid almost half that of what the forklift driver in China is being paid. So we're seeing a substantial shift in supply chains, this sort of old just-in-time inventory management where companies would rely on being able to fly parts in within a week or 2 weeks. That's really moved to just in case we need to hold more widgets in our process because we can't rely on global supply chains as much as we used to. So no, absolutely, the silver lining is definitely where our strategy is taking the REIT, which is in logistics and light industrial.
Give us the sweet spots, Jörg, in Europe that the REIT manager has identified.
Yeah, I mean, as many problems as you might have in the office sector, Simon, in Poland, I think this is still a very strong market, a recipient for a lot of investment from the production side of things, as well as from the logistics perspective. I mean, it has come down a little bit, but Poland is still going strong in terms of industrial logistics take up. I would say everything that Simon has referred to in terms of supply chain disruptions, in terms of just in case being prepared for difficult times, is absolutely correct. I still see a lot of retailers becoming omni-channel operators only now. We see a lot of traditional retailers, physical retailers, that now have to really finally get into the online sphere. So just to give you a few examples, okay, we've just recently signed a 100,000 square meter deal of a global retailer in Czech Republic. They're going to invest 400 million into their automation system in their 100,000 square meter building. And that's happening right now. So I think that's a testimonial to the fact that online is going to grow. Okay. I'm running a similar project for a German, very conservative operator of fashion department stores. They are looking into one time 30, 40,000 square meters in Slovakia, one time 90,000 square meters in Poland. That is all happening in a time where everybody's talking about the declining confidence of consumers, which undoubtedly, we see as well. But I think there's simply a continuous structural need for change for a lot of these operators out there. And insofar, I think, yes, the overall demand and take-up will decrease. I would be very surprised if that was not the case. In the next 6 months, we're going to see a recession. But I think we'll see a very interesting combination of a declining market as far as GDP is concerned, and are still a relatively healthy take up as far as the logistics and industrial world is concerned. The thing that keeps me up at night, and I think I said this earlier, is simply the lack of space. And hand in hand with the obviously more complicated, more costly development, a lot of developers are now simply saying that we hold on for a couple of months, we hold on for a couple of quarters with more speculative development, and the simple result will be focus on build-to-suit projects, and another one will be even faster growing rents. That's what I see happening over the next 6, 12, 18 months.
Well, Simon, your insurance is long leases, right? Long leases as good as the businesses they are involved in. If the lessee's businesses decline for any reason, then there would be reasons to worry, isn't it?
So in 2020, out of 850 tenants, we had 2 bankruptcies.
Oh, that's very little. Yeah. But that's when. Now, is there signs in Europe, in the markets, that businesses are picking up and it's growing?
As Jörg said, the forecasts are for recession, mild recession, 0 to -1% thereabouts next year, caused by the higher interest rates to sort of slow down the demand side to keep inflation in check. We haven't seen it yet from a logistics perspective. We're still getting good rent growth. We're still getting inquiries for any vacancy that we have. We're still able to lift rents. And from an office perspective, tenants like the Dutch government or groups like KPMG, they're looking for high quality buildings. So to the extent that I would say 75 to 80% of our office buildings are BREEAM certified, and therefore we can demonstrate to those tenants that we have the end of trip facilities, we've got the electric vehicle charging stations, we've got the LED lights, we're doing all the things we can to reduce energy, we're doing okay in those buildings. As I said, the Polish office buildings, particularly in Warsaw, and some of our second tier office assets that aren't in the prime location, they're the ones that over the next 12 to 24 months that we've planned to dispose of. Who's buying these assets? Well, many of these assets are valued at land cost only, and so they lend themselves to residential conversion or conversion to student accommodation or even hotels in the case of one of our coastal assets in Italy. So we're aware that there's a bit of an anchor for some of our assets over the DPU performance, and I can see some questions that have come through from people on screens, and that's something that we're addressing. The silver lining is long-term, we think logistics from a cash flow perspective and premium office, which will attract a greater market share of office tenants, will put the portfolio in good stead.
Right. We got some pre-submitted questions. A few of your unit holders have asked us to put this to you. The declining share price, they want your comments on. Share price depends on performance, business performance and sentiments. So what is your comment on this? And also, why there is negative free cash flow for 2 years or more? Any plans to improve?
Yeah, so let me just deal with that last question. That's not a correct statement. In fact, our operating cash flow has been close to 100 million for the last 2 years. And in the June half, we reported almost 45 million, which is equal to the distribution, as you rightly said, it's roughly 50 million every 6 months. So no problems with the operating cash flow. Even during 2020, we collected 99% of the tenant rents, which was very, very strong. In terms of the first question around the share price, as Elena's just pointed to, our strategy of pivoting to logistics was actually materially working from a share price perspective. You can see the dark blue line. Up until February this year, we were trading at a premium to the Singapore REIT sector, and we were starting to trade at a premium to our NAV, in line with all of the other logistic REITs, which in Singapore, as you know, were trading at much higher premiums, with the office REITs trading at discount. So our pivot was certainly working from a share price perspective. And then along came the Russian invasion of Ukraine. And then more recently, the series of ECB interest rate increases has seen, unfortunately, a greater decline versus the Singapore REIT sector. Pleasingly, we've been outperforming our European peers that are listed in Europe. So many of our investors are based in Europe. So they've actually been benefiting on a relative basis. I know it's not the same as an absolute basis, but on a relative basis, we've been performing better than the European REITs.
Simon, let me now pivot to light industrial and logistics assets. Office assets now account for 49.5% of the overall portfolio. The REIT has been actively recycling its capital from office assets to logistics and industrial properties, as you said. The main question is, have you set a target for the percentage of the portfolio for light industrial and logistics assets?
So I know you're one for disclosure regime. We've only said publicly greater than 50%.
Okay.
We've deliberately not provided an end target because things can change. I think as someone has asked here, at what point is all of this good news priced into the logistic assets? Clearly, we like the sector, but I just don't want to be held to a target that, for whatever reason, we may end up changing in 3 or 4 years' time. But certainly investors should be aware that our focus has been on selling non-core office and smaller logistic assets to acquire very high quality core plus value add logistic assets, both in town last mile, as well as assets located on very good infrastructure, such as new freeways, etc.
Fair enough, Simon. But is the current pace of asset recycling optimal? Are there any intentions to speed up or slow down the asset recycling?
Yeah. So with rising interest rates, we've seen a bid-ask spread emerge. So, buyers who would normally use a higher level of debt in their purchase capital, obviously that debt cost has increased, and so therefore they can't use as much debt to get the same sort of returns. So we will be trying to accelerate our sales and recycle that capital into our own developments and potentially buy our own stock back, given the massive discount we're trading at NAV. But it's tricky. So not every asset that you want to sell will find a buyer today at the price that we think over the long term on a risk-adjusted basis is good for unit holders.
Simon, I'm tiring you, but there's 21 questions where we...
I'm more worried about Jorg's lunch than I am about my dinner.
We will have him leave in about 20 minutes.
That's okay.
But, thank you. Now, Simon, given the low vacancy, is it low vacancy? You said 91% occupation, isn't it?
97.
97.
In logistics,
So
96 across the
so
portfolio.
it's not correct to say low vacancy. Do we have some new supply of logistics space? Any update on Cromwell REIT's interest in data centers? Data centers, has the higher energy prices affected the decision? Has it affected the decision? You described the logistics market as being very strong. Example, rising rents, occupancies. Is there a risk you pivot? Your pivot is just chasing an already expensive market. There's live questions right now.
Okay, 3 questions in there. So firstly, we will always have some level of vacancy in our light industrial and logistics portfolio. If we've got a park with 30 tenants, sometimes those tenants need to leave because either they can't afford the particular rent that we know we can charge in the market. So for example, in Paris, the French post office was paying 90 euros a square meter. The market for that space at the end of their lease was 150 euros a square meter. They said, we don't want to pay it, that they have their own buildings that they own. We said, fine, you go into your own building. And then within a month, we had released their space at the 150. So, we will report some vacancy during that negotiation period. The second question is around data centers.
Yes.
We spent a lot of our time in 2019 and 2020 looking at a couple of development sites, one in particular in Frankfurt, leased to one of the three big US hyperscalers, one of the big three. Unfortunately, their leasing, their market power was too much for the risk that we wanted to take on. In other words, we were happy to build the core and shell, so the concrete and the roof. On average, that might cost us 50 million euros. They wanted us to spend 150 million doing the fit out of all of the wiring, all of the cooling stations, all of the mechanical components, other than the blinky lights on the servers. And for us, that introduced operating risk. And we are not operators of data centers. We were happy to be a silent landlord, if you like, for the core and shell, but certainly once the discussion started to get into the financing of 150 million euros, it was just too much risk. So we've walked away. To your second point around, was it because of energy prices? That certainly stops a number of developments. So a number of countries such as the Netherlands, as indeed in Singapore, have put moratoriums on new data centers. So there will be a slowdown. So two fundamental reasons we don't like. The tenants have too much power versus the landlord, and two, some of these ESG risks are getting too great for us. And
here is a worry on the part of one of your unit holders. He says, how do you overcome the issue of being located quite far away from the countries of investment? Isn't it particularly challenging to keep track of changing legal requirements and market conditions, investing in various countries, especially while not located there?
Yeah, I think that's a really important point to reiterate to all of the investors on the line, is that there's 220 very experienced real estate staff, finance staff, tax staff, legal staff sitting in those markets that we invest in. We've said for the last 5 years, we would not invest in countries in Europe that we don't have those local on the ground expertise with. So while I might be the spokesperson as the CEO of the REIT, rest assured that there is a very strong team on the ground, and again, with having experts such as Jorg on the line, again, just demonstrates that again, we can tap into the wonderful expertise that CBRE and other brokers have within these various markets. How does that manifest itself? Well, of the 55 properties that we've bought since listing, only one was bought on market. So by the time CBRE comes around with a glossy brochure and starts, coming to Singapore to talk to potential Singapore REITs, our teams on the ground have already seen that asset and have declined it. So only one of those assets did we actually participate in a broadly marketed property. That was one in Germany. So our truffle hunters, as we call them, our transaction teams on the ground, are very aware of what's going on from a tax perspective, from a leasing perspective. And some of the assets that we've bought in the last couple of years, where we've bought 30% below valuation, where we've bought on very high yields, again, just shows that we've been able to buy from distressed vendors because our team's on the ground. Example was a property we bought in Italy when a major US private equity firm could not complete on the purchase because they were trapped in the States and couldn't do their due diligence. Our local team hopped in the car, did the DD, and within 4 weeks, we'd bought a wonderful property at a big discount, a very high yield that has been very successful since purchase. So can't emphasize enough having the on-the-ground team. In terms of my background, I used to run the global research for both Bank of America Merrill Lynch and UBS for the last 15 years prior to this role. So I've been actively involved in REITs both in Europe, US, Japan, and Australia for a long period of time, since 1994. So I've seen a number of financial crises. My scars are itching, which is one of the reasons that we spent a lot of time this year refinancing our debt so that at least we could remove that risk over the next couple of years this year rather than waiting into next year.
You did say that Poland is has a poor performance as a country. Yeah, a few others as well, isn't it?
So when I said it as a country, I mean as an office market specific to the increase in the vacancy due to the supply. So,
Yeah.
you know, if we had logistic assets there or light industrial assets in Poland, I would be a lot more optimistic. But it's because specifically of our office, and specifically our Warsaw assets.
Yeah.
Helsinki in Finland, while we've got a small exposure there, hasn't been a great performer for us. Certainly the yields are high, but our ability to lease up that smaller portfolio is behind our schedule. But our core markets of the Netherlands, Northern Italy, France and Germany, which is almost 80% of the portfolio, performed exceptionally well. And I'd add in there the Danish, the Copenhagen market. It's a wonderful opportunity if any of your investors get a chance to go and see the amount of infrastructure that's being built and has been built in Copenhagen that really links Germany through to the Nordics. A new tunnel through Hamburg, up into Copenhagen, obviously across the bridge to Malmo and up into Scandinavia.
So there is a
wonderful market.
Rationalization of those assets towards stronger European cities.
Yes, exactly.
Yes, thank you. So one of the participants asked this earlier, and he says that I've not really allowed you to answer. How did you didn't give Simon a chance to answer my question? Here it is again. You described the logistics market as being very strong, rising rents and occupancies. Is there a risk you pivot? Your pivot is just chasing an already expensive market?
It's something that we obviously worry about whenever we make an acquisition, and we have an internal 13 risk factor matrix model. So when we look at an acquisition, we don't just look at the expected returns, we also look at the risk. And so we may in say Tilburg in Netherlands, which is a core logistics market, we may pay a lower yield or a higher price per square meter, but the risk of that asset, the location of the asset, the fact that it's new, it's got solar panels, it's highly rated from an ESG perspective, we were prepared to pay a lower yield for that asset. Elena, if you could turn to page 21, which just shows the average portfolio yield. I think this is really important. We did not go and chase 15-year leased Amazon sheds in Barcelona at a 3 to 3.25% cap rate. That was not the type of asset that we were looking at buying. There were a lot of REITs, a lot of sovereign wealth funds, as Jorg will talk about, that went in and paid very low cap rates for that core asset. Our average cap rate that we've been buying is around the 6 to 6.5% level. In other words, we've been buying assets that suit our asset management team's natural ability to take on more active leasing risk. So there may have been, in one case in Milan, a property that only had 2 years left on the lease to the major Swedish robot company ABB. And already within a few months, we've got very significant leasing success. So we've been prepared to take on some leasing risk, take advantage of the strong underlying demand from tenants, the lack of occupancy, and therefore we've received a slightly lower price or higher yield to take on that risk. We have not chased those very low yield assets. Having said that, UK, with all of the well-published problems in the last 3 months, certainly the 3 warehouses that we bought in the last 12 months in the UK won't be pretty from a valuation perspective when it comes to February, when we release our results. The UK market across most asset classes has corrected the most from the rise in interest rates, from the rise in cap rates. And again, Jorg is in a really good position to be able to explain more, but certainly our 3 smaller UK assets, we would expect to show disappointing revaluation losses relative to the rest of our portfolio that we expect on average to perform very well because of this high starting yield at 6% relative to the cost of debt. You can see there the yellow line, which even with the interest rate increases is still less than 2%. which is much lower than, say, in the US, which is over 4%. So we have that good spread between our property yield and our funding costs.
Simon, have you given an overview of the pipeline of major AEIs and developments? I think you did touch on that.
Again, this is a first for your investors today. We've put a new chart in today.
Yes.
So we've actually outlined the buildings with an estimate of cost.
Yes.
And a timeline as to when we expect these projects to complete. Now, so obviously the ones in 2026, 2027, we're still going through the planning process, but the near-term assets have either commenced or very soon to commence. So that's roughly 250 million. And then Parc de Dock, which is the much larger portfolio of warehouses in the Saint-Denis, Saint-Ouen district in North Paris. There you can see the island in the bottom right-hand photograph. That's the new Paris Olympic Village. The Stade de France and some of the other infrastructure for the Olympics is nearby. So this is a wonderful asset that we would expect to be a material contributor for 10 years or so from 2026 beyond when we get the master planning approval. This one's very exciting. It's not a near-term contribution to the portfolio, but for investors that are looking for 10 years, which some of our large institutional investors who are also on this call today certainly are very excited when they go and see this asset, and certainly will back us over the long term to deliver substantial upside from this particular asset.
So what is the economic outlook, one is asking, for the European Union, given the threat we have now from Ukraine? How worried are you?
Yeah, it's not Ukraine itself which is the threat to Europe GDP. I mean, you go to most parts of Western Europe or the Nordics, and life has returned to normal. I mean, we've got some Google mobility stats to show that in most European cities, people have returned into the cities back to their pre-pandemic levels. So the economy is not being hindered by the Ukraine war per se. It's certainly being hindered by higher energy costs. You know, if you think about the very large German chemical companies that use a lot of power, clearly those companies are hurting. Steel manufacturers, producers will be impacted. But on the offside of that is the consumer. I mean, we're starting this recessionary cycle with very low unemployment and high savings, and sort of that revenge spending is manifesting itself. You try and go to any of the European airports from Singapore, and good luck trying to get a booking to Paris from Singapore at anything less than $10,000. There's still big pockets of the economy which are doing well. We're talking generally economic forecasts are between 0 and -1% for 2023. We think about 2020, that was -7% GDP. So the recession that everyone's thinking about for 2023 is only a mild one induced by rising interest rates due to inflation. That inflation is obviously global, not just from a Europe perspective. So generally speaking, it's a mild recession. Recessions typically don't cause property crashes. It's the credit cycle that typically causes a property collapse. And that's something that I continue to reinforce to you and your investors, that we have taken large mitigating steps to protect us in case if that black swan event was to occur.
Here's a question about cap rates. Will the rate hike affect the cap rate and result in decrease of property's value? How do the current inflation and rising interest rates and falling value of the euro affect the NAV and DPU of Cromwell? Is 3 questions. Will the inflation adjustment for rental offset any potential cap rate compression?
York, do you want to answer that first question around expectation of cap rates and what that might mean to logistic valuations? I know you're not a valuer, but just from your perspective, what do you see at the moment? What's the chatter?
Not a valuer and not a capital markets person, but I mean, obviously, the yields have softened already quite significantly, as everyone can imagine. I mean, we've come to a factual standstill in terms of capital markets transactions for the time being. We don't see any much activity in the next 3 to 4 months. Our general expectation is that yields will start to come down again, probably not earlier than by the end of 2023. So until then, we'll see expansion of yields, and then they will come back in. But I mean, we've seen yields, cap rates going up now between 50 and 100 and 120 and 150 points, depending on which market you look at. You said it earlier, Simon. I mean, we have quite a fragmented situation when you look at financing costs still across Europe, and that comes within that context. Yeah, so that's our house view. Until the end of next year, we won't see a recovery of yields, but then we should look at normalizing times again.
So David, if I can take up the second part of the question, and we've provided again for the first time tonight a sensitivity here, so that if you do see a 5% reduction in the valuation across all of our assets, then the LTV may increase to 41%, assuming we don't sell any assets. So that's a big proviso. And the second is that the NAV per unit may fall down to €2.26 or 24 cents decline. And that's reference to a share price at $1.50. So even with the 5% cut to property values, we're still trading at sort of that 20 to 25% discount to the NAV. So I would argue that a lot of the increase in cap rates, which will be offset by the increase in market rents and higher inflation expectation and our better leasing success, will mitigate some of that cap rate increase. But again, even in my prepared remarks, not just CEREIT, but globally, you should expect asset values, not just real estate, but real assets to fall. Interest rates, which have been zero for a long time, inflating assets, that will come off. I just wanted, again, there's a lot of fear in the share price, and I wanted to put in here a scenario that says a 5% reduction doesn't cause us problems on an LTV basis and doesn't cause us a problem on an NAV. Clearly, it doesn't impact our distribution because the distribution is not tied to values. It's tied to the strength of the tenants. And again, we've got 95.5% occupancy level, and we would expect that to be maintained over the next 12 months. We think it's a short, shallow recession before central banks have to start cutting rates again. And you can already see that in the US. You can already see the rally in the yield curves. You can now see that the yield curve is inverted. And we think the same thing will happen in Europe in the next 6 months. So we're going through this transition phase, which I don't think will be as long as the share price is indicating.
Simon, one of your live audience, Gunther, besides showing a chart indicating the income available for distribution, can you please also share a chart on DPU development, including Q3? Do you have a chart on that?
We haven't declared a DPU for the Q3,
right?
Because we only need to declare every 6 months. So it would be early. I don't think you'll find any other REIT declaring a dividend that's theoretical. But the guidance to give you is that roughly the last 2 years we've paid roughly 17 cents. As you can see from the results, we're on track to be close to that again. And at $1.50, that would put us on a 12% yield. And we've provided some scenarios that even next year with higher interest rates, we'd still be on a 10% yield.
Right. Finally, CPI and inflation is a worry. From your third quarter presentation, I see that CPI is in the double digit for some countries. In the Netherlands, it is 10.5. Italy 8, Poland is 14.4, Czech Republic 16. So is high inflation good for the Cromwell European REIT, given that your leases have rental uplift based on CPI? How soon does it take for the CPI indexation uplift to flow through to distributable income?
Yeah, that's a really good question. And it's something that sets us apart relative to some of the Asian REITs that don't have this inflation index in their leases. So almost all of our leases have inflation. Some markets like the UK will have a cap So in the UK, our 3 leases will have caps at around 3%. So even if inflation was 10, we can only increase the rent by 3%. In Italy, for example, we're only able to capture 75% of inflation. So if inflation's 8%, we can charge 6%. In Central Europe, our leases are in euros, so we don't take, say, Polish zloty risk. We're in euros, and so the inflation that we increase our rents on is based on the euro inflation. Peculiar to some countries, the indexation happens in the first quarter of the following year. So from a lag perspective, 2023 should benefit more from the inflation in 2022. It should kick through into 2023. So there's a double-edged sword in the question. Is it good for CEREIT? Absolutely, from an income perspective. The negative, obviously, is the reserve banks are putting up interest rates to soften that inflation. So yes, in the short term, we will get good income growth.
What about energy prices?
95% of our tenants pay the energy price directly.
Directly, okay.
Now, there may be a lag in the pass-through, but 95% pay. Now, in some countries, we still have energy contracts that were put in place 1 or 2 years ago. Yeah. So the tenants haven't yet been impacted from the recent rise. Right. Secondly, there's a lot of government subsidies throughout, both not just for mum and dad households, but also for corporates. In fact, the latest one is Poland, where there's quite an attractive subsidy for smaller owners like ourselves to pass through to our tenants on very material government subsidies. So again, the headlines that you see aren't necessarily what transposes through to the tenant.
You tired, or you can take a few more questions?
This is the best part of my evening, David. I love this.
Okay.
Oh, really? I mean,
it's really good questions coming through, isn't it?
Yeah, we love it.
And that shows keen interest in your REIT. You know, with the new loan facility, what should be the all-in interest rate by end of December 2022? What is the proportion of the leases linked to inflation? What is the typical inflation-linked clause?
Yes, I think we've dealt with that last question, which is 100% about our leases.
Yeah.
But in terms of the interest rate, in terms of the interest rate question, at June, our average in-place debt was 1.7%. Yeah. But a lot of that debt was expiring in the next 2 years. So we've refinanced that. Right. And so our all-in cost of debt is just over 2% now.
Oh, good.
Now, some of it is hedged, or most of it's hedged. There's a part that's not hedged. Yes. And so as interest rates go up, so yeah, roughly 2.2, 2.3%, thereabouts.
Thank you. May I know what's the usual security deposit for CEREIT's properties?
If that's with regards to tenant deposits and guarantees, okay. Yep. Typically it's between 2 to 6 months, depends on the length of the lease, the credit quality of the tenant, etc. More in bank guarantees and less in cash deposits.
The final question for tonight is, what are the 4 biggest challenges for Cromwell REIT, please? Would you mind summarizing that? If there isn't 4, there must be 3.
Yeah. So it depends on the perspective of where the question is coming from. I mean, clearly, investors are interested in total return. They're interested in capital price, the share price, and they're interested in the dividend and the dividend yield. And normally over the last 20 years, the REITs in Singapore have provided roughly 70% of the return is income and 30% of the return is capital growth. So from an income perspective, that is more important to drive the share price than anticipation of the capital growth within the portfolio. So we're doing everything we can from an income perspective. So that's things like maintaining high levels of occupancy. It means when we have leases coming up that we're able to keep the tenant or we're able to charge them a higher rent. So from a risk perspective, if we can't lease our buildings, or if we can't promote the rents, then clearly that's a risk that we are concerned about. It's not a base case risk, but it is a risk nonetheless when we think about our dividend. The second is around interest rates, and we've spent a lot of time talking tonight about how we've tried to mitigate those interest rate risks through the hedging and the refinancing, but there's still some element of risk. And the third risk to investors, which we really haven't touched on tonight, is the weakness of the euro. You know, part of the share price underperformance this year is the strength in the Sing dollar versus the euro. I think in the last couple of weeks, we've started to see a turnaround in that aspect, but that is a risk that I can't control, but it is a risk that your investors, you know, take on. You know, they can trade in Sing dollars or they can trade in euros, but typically our investors trade in the euros.
Can you manage a increase in finance costs with rental increase or inflationary adjustments?
Yes, yeah. So that you know, that risk, what we've tried to do in that sensitivity page that we published the SGX tonight, which we've really tried to help answer many of the questions from your investors tonight, is trying to show two things. One, if interest rates are increased from the current 1.4% up to 2.5, it's really not a major issue on the DPU. It's roughly about a 10% or around 5%, around 1 cent off the dividend. So rather than being 17 cents, all things being equal, it would fall down to 16 cents. You know, when you're talking about $1.50, that's still an 11% dividend yield. And the second is around that all REITs will face is in declining valuations. How much can you absorb before your LTV covenants start to hit their ceiling? And we're very well advanced in asset sales. We've got a track record already of selling assets. We've got more to come. And so that's a mitigant to falling asset values. Falling asset values in of itself does not change the dividend. But from an NAV perspective, clearly there's some decline. If we can sell assets to plan, and we're still trading at this substantial discount to NAV, then we've said previously that we would look to put on a buyback. You know, we go to shareholders every year for at the AGM for a refresh. It is something that we would look to do when we know with a little bit more certainty around the outlook of interest rates and the outlook of valuations. And as Jorg has talked about tonight, you know, the view is that the next 6 to 9 months is probably the trough before we start to see more reductions in interest rates in expectations than increase in interest rate expectations. We'd expect to see inflation come down.
Yeah, Simon, there is an increasing worry about DPU growth over the last few years. They feel that it is somewhat inconsistent or weak at best. Is Cromwell's recent portfolio changes expected to change all this?
Absolutely,
Yeah.
absolutely. You know, we knew that if we stayed in office,
yes,
our DPU would continue to fall with the higher levels of incentives and the capital that's required. So that's why we set out in the end of 2019, beginning of 2020, to really shift this portfolio to logistics and really take advantage of the higher rent growth and income growth and tenant demand that Jorg and I have talked a lot about tonight. So, you know, we're conscious that 2020 was a bad year for everyone because of COVID. Having said that, we were still able to only have a 2% decline in our dividend. So, you know, in the context of falling dividends, please remember we went through the world's worst recession in 2020 and we only saw a 2% decline in our dividend on a like-for-like basis. So we're pretty happy with that.
Yeah.
And then, you know, this year, if we can be anywhere near the level of last year in a higher interest rate environment, we think that's a very good outcome, particularly when the share price is indicating a substantial fall in dividend. You know, we're trading at 12% yield.
At least 10% yield.
Yeah.
Yeah, good. And shall we let Yog have his lunch then? Have your lunch, Yog. Thank you for joining us. Simon, it's been a great night. You fielded all the questions, very good questions from your unit holders and from SIAS. We'd like to meet you again and keep this conversation going. It's been a terrific night. Thank you very much. I'm sure participants would appreciate Simon and Yog's candid answers. And this is what SIAS does to bring you the information that you ask for so that you can make an informed decision. I think it's a great company. Thank you very much. And we'll meet you again, Simon. Yog, good night.
Thank you very much.
Thank you, everyone. Appreciate you hosting us. Thank you. Bye-bye.
Bye-bye.